Thank you for joining today's presentation. It's all about asset location. Most investors focus considerable time on asset allocation, or the process of determining how much of their portfolio to allocate to asset classes such as stocks, bonds, cash, and alternatives. But what about asset location? This topic is seldom discussed, if discussed at all. In this presentation, I'm going to provide some examples on how to help explain what you're doing already when it comes to asset location, shed some light on how to deal with more complex situations, and hopefully uncover some opportunities that you can incorporate into your practice. Today's objectives. What is asset location? Why does it matter? And how can we take the most advantage of it? Most of what I'll cover can be explained on the following slide. And here it is. Sorry I didn't make it fuzzy on purpose, and I'm not going to get into any of it right now, but we will revisit this slide again in a few minutes, and my hope is that it will make quite a bit of sense. Asset location defined. Sometimes you can really lose your head when it comes to what asset is best held in what place. But we'll see in a minute why it's important for you and your clients. And why should you care? How many of you have otherwise seen good planning derailed when assets weren't properly located? And why should you really care? Greenbacks. You can almost smell them. That's why you should care, and I can see some of you perking up already. In fact, some research has suggested that asset location decisions can add anywhere from 20 to 50 basis points of additional free return. How much can that really add up to? Well, if you run this over a 30-year period and the annual return was somewhere around 0.5%, you could add 15% to the terminal value over a 30-year period. That's the difference between $1,150,000 versus just $1 million. Asset location choices. Lots of shiny buckets, but what asset should go into what bucket? And granted, most folks, at least for now, aren't worried about the things in their estate, but with life expectancies continue to creep up and Congress chasing down more tax revenue, who knows what the estate tax policy will be in 20, 30, 40, or even 50 years from today. That's why I've been very proactive, particularly for my younger clients who face a 40-year plus time horizon and are already in a place where they're starting to have tax concerns. So your choices here are whether they're taxable, tax-deferred, or tax-free, and your choices are locating that continually in your estate, or sometimes having opportunities to locate those assets outside of your estate. If real portfolios were only this simple, here Mr. and Mrs. Smith collectively have $1 million as shown. Mrs. Smith one day asked the question to her husband John. She says, "Honey, it's been really bothering me lately about whether our bond portfolio should be held in the IRA accounts or our tenants buy the entirety accounts." I'm sure you get asked this question all the time, right? So let's try to quantify this for Mrs. Smith on the next two slides. First, we'll look at putting bonds into the taxable account. Next, we'll put them in the tax-deferred IRA account. And as you see from this slide here, $1 million evenly divided between a taxable account and a tax-deferred IRA account. Some simplified assumptions for us to be able to do this analysis is that we're going to allocate half the money to stocks, half the money to bonds. Stocks will have an expected long-term return of 10% and will enjoy a 15% long-term capital gain. Bonds will have an expected return of 5% and have a 25% ordinary income tax. Important to realize, investments will be held for 30 years, no investment turnover or rebalancing, and at the end, both of those accounts will be liquidated for us to figure out the terminal values. So let's walk through this slide. It's a busy slide. There's a lot of things on it. But this first scenario is bonds are held in a taxable account. The bonds are earning 5% gross, but because they're a taxable account and because bonds throw off ordinary income every year, 25% of that gain, or in this case 1.25% of the 5%, will reduce annual return to 3.75%. After 30 years, at the end of 30 years, that $500,000 will grow at a 3.75 after-tax rate and will be a little over $1.5 million. Stocks in the tax-deferred account grow at a 10% gross return for 30 years, and then at the end of 30 years, all withdrawals will actually pay a 25% tax rate when that money comes out of the tax-deferred account. In this case, the total would be $8.7 million, less the 25%, somewhere around $6.5 million, for a total return a little over $8 million, having bonds in the taxable account. This next scenario shows bonds in an IRA account. Bonds are now being tax deferred, which means their 5% will grow for 30 years, and only at the end will the taxes be taken out. So at the end of it, the bonds will grow to a little over $2 million. The 25% tax will come out. That will leave us with a net of $1.6 million. Stocks are now in a taxable account, which means they'll grow at that same 10% gross return for 30 years, and then at the end, will enjoy the preferential 15% long-term capital gain rate. So at the end of 30 years, the gross will be $7.49 million. Remembering also that in this case, you're paying only on the gain. So we're deducting out the $500,000 cost basis in the stock account for a total of $9.1 million. We can clearly see that this total here, bonds in the IRA account, clearly in this scenario works out more advantageous for the client. And when we look at this, we learn a few things here. In essence, what we learn is it's typically good to defer bonds' annual ordinary income tax until withdrawn. Things being equal, it's always better, in this case at that same rate, to defer it down the road, to let it grow at the gross amount and then take it out versus taking it out along the way. Stocks, on the other hand, enjoy the preferential long-term capital gain when they're in the taxable account, and you only pay the taxes if and when a gain is realized, and we'll talk a little bit more about that at the end of the presentation. So here actually is a real-world portfolio. In this case, a $2 million portfolio, and as we can see, in this case, we have several accounts, but almost all of them, except for $100,000, are tax deferred. So in other words, there's not a whole lot we have that can go in a taxable account. Not only that, in this situation, in a real client case, there are some constraints. We've got some money in a tax-deferred accounts through their employer, which we're only allowed to use mutual funds. They also have some retirement assets and Canadian accounts, which for our sake allows us to get positioned in U.S. exchange-traded funds. Another real-world portfolio, a $10 million portfolio, this is quite the opposite. All of it here, in essence, is taxable. Just a little bit is tax deferred. So just about all our decisions will be related to the taxable side. Very little or very few things we'll be able to actually put in the tax deferred account. Another factor, and a very important factor when we talk about asset location, is the expected return. If the expected return of the asset class is low, there's simply not much benefit to tax deferral. Another way of saying the same thing, the higher the expected return, the greater the benefit from tax deferral. So in other words, when we have buckets that we can have tax deferral, we only want to fill them up with assets that will take best advantage of those accounts. These next two slides, we're actually going to walk through where we talk about two scenarios where we talk about relative attractiveness to locate different types of assets in tax-deferred accounts. Here we have Charisse investing $100,000 in taxable bonds for 30 years. Should she locate these bonds in a taxable or a tax-deferred account? The term is 30 years. Her ordinary tax rate is 25%. What we're clearly showing here is it depends, and it depends on her expected or her realized return. And what we're seeing is if those bonds only average around a 2% return, the difference, the benefit of tax deferral is very, very small relative to the amount of money, whereas that benefit, as we can see, starts to go up as the return goes up. Just as we talked about in the earlier slide when we talked about expected return, if the expected return is low, there's simply not much benefit. The higher the return, the more the benefit. And this was on an ordinary income asset. Next, we'll do the same scenario, but this is a capital gain asset, a very tax efficient asset, a U.S. broad market indexed fund. And in this case, should Wendell invest his $100,000 in the U.S. broad index fund in a taxable or tax deferred account? In this case, his ordinary income rate is the same 25% and the long-term rate the same 15%. Here we clearly see that there is an advantage, and right off the bat, there's more of an advantage even at the lower interest rate than there was on the ordinary income asset. And if you think through this, if you think about something that's very tax efficient, in essence, it's getting its own tax deferral. If you own a long-term stock or a fund of the U.S. broad index that has very, very little turnover, very little, if any, realized gains over that period, you're in essence deferring all of that gain to the end of this 30-year period, and even then you're selling out at the preferential long-term capital gain rate, which will always be lower than whatever your ordinary tax rate is, at least based on current tax policy and policy we've seen, where no matter, even if these do go up, as we see that they can, your long-term capital gain rate could go from 15 to 20 or 20 to 23.8, depending on your ordinary income. But similarly, your ordinary income rate is going up by definition as well. And what we can clearly see is higher returns are much better allocated in taxable accounts for those investments that are very, very tax efficient, something we'll cover a little bit in just a moment. So what happens when, as we talked about, capital gains rates increase all the way up to their 23.8%? Net investment income tax rates max out at the 43.4% top rate for ordinary income. A taxpayer is subjected to additional state income tax. We tend to forget sometimes, being in Florida, that most of our brethren across the country has to pick up state taxes. We've seen legislation these days that have particularly increased that for high wage earners as well. So those state tax increases will become more and more of a factor. What happens if we have municipal bonds enter the mix? What if investors' accounts, as we demonstrated in those two different scenarios, are lopsided, either nearly all taxable or tax deferred? Well, let's walk through a scenario here where we're going to show a hierarchy of what should go in where on a prioritized basis. Up here, you see things that are least tax efficient. So those would be things that naturally you would want to locate in a tax deferred account. Here you would see things that are much more tax efficient. You'd arguably want to put them in a taxable account. So when we start off very efficient, we look at things, no surprise, bonds, particularly bonds throwing off a lot of income, such as high yield taxable bonds, real estate, any high turnover active stock, because turnover means you're going to be generating not only long-term gains, but also ordinary income quite possibly as well, as those managers buy and sell as a function of the active fund. And then in this case, active as well on a small capitalization fund. Moderately inefficient would be something that would be more of an index, but you're seeing this clearly without an ETF or an exchange-traded fund class. And when we talk about that, what that really means is, things being equal, if you can get in the same container your basket in an exchange-traded fund versus a mutual fund, you're going to have better tax efficiency by the structure of the creation and redemption process of the exchange-traded fund, whereas mutual funds can generate a fair amount of ordinary and capital gains, whether or not they were actually represented by when you were in the fund. Efficient, when we talk about efficient, here we see things that are exchange-traded funds or index funds. when we talk about small cap international or index funds as well, efficient that we have here, things that are in an index. When you get out of active management on the stock side, you can increase the amount of efficiency when it comes to taxes. Very efficient when we look at these. No surprise, we're seeing a lot of things here that are tax managed. By definition, if you've got enough dollars, you may rather be in a mutual fund or even an exchange traded fund. You may want to synthetically create your own broad market index so that you can harvest losses and you can manage your taxes most efficiently. So here's that chart again. Let's take a look at it. We're going to spend a little time walking through this. And let's first identify both axes and see what's going on. Over here we have from 0 going all the way up. This is your pre-tax return. At the top is the highest. Down at the bottom is the lowest of your pre-tax return. Going across the bottom, we have efficiency. This is your tax efficiency. 100% would be something very tax efficient. 0 would be something very inefficient. And right off the bat, we've seen things. And this really brings into focus some of the information we've seen on the previous slides. And that, if we have something here in the blue that isn't returning a whole lot, it really doesn't matter a whole lot. Differences are small, and it really doesn't matter where you're locating those assets. However, as we go up in return, it matters quite a bit. Clearly, if we go up and something is tax efficient, you want to have that in your taxable account, because as we saw, you're in essence being able to defer some of those taxes anyways by having unrealized gains, and then when you do realize the gains, you're paying at that lower long-term capital gain rate. Over here on this side, this would be something that would be very tax inefficient here, and this would be something you would want to put in your IRA account. Here, you have tax inefficiency, which means you would be paying those taxes every year on ordinary income. However, if it was in an IRA or other tax-deferred account, you would not pay them. It wouldn't really matter. You're going to pay ordinary income when it comes out, irrespective of what happens day in and day out. And here, in the purple, this is the area that will matter based on the individual investor, because as we know, a lot of this is highly subjective to their individual tax situation and the brackets that they're in. So this one slide allows you to get a feel right off the bat and clearly showing what assets clearly have a preference for being on the taxable side, what assets really should be located, things being equal, on a tax deferred side. So a practical approach. Let's talk a little bit more about a practical approach or lessons learned in these past slides. Number one, to the extent that you have a tax-free bucket, fill that up with something that has the highest expected return, and the more tax inefficient, the better. By definition, this Roth IRA held till at least age 59 and a half will be tax-free. So by definition, the most benefit out of that, or in essence to insulate yourself or get most advantage of that, would to be have something that would have the best chance to grow the highest, and things being equal, the more tax inefficient, the better. Because remember, if you have things that are very tax efficient, you could very well just stick them in a regular taxable account and not waste the bucket of the tax-free account of the Roth IRA on that asset. Next up would be the tax-deferred account. Here, then again, after that, after the Roth, the most tax-inefficient assets as well, with at least some minimal level of return. You don't want to waste the tax inefficiencies either. You want to be able to put something in there that can take advantage of that. And then you want to allocate those assets with high expected returns and high tax efficiency to taxable accounts. That would be things that would be your equity indexes, preferably exchange traded funds as well, that are extraordinarily tax efficient and have that opportunity for reasonably high expected returns, particularly over long periods of time. Then fourth, you should look to locate higher growth assets, to long-term accounts. By that we mean, things being equal, the longer you can defer a gain. The beauty of stocks and equities, you don't realize a gain until you transact. So if you had an account such as a child or grandchild's account that you were saving for their retirement 30, 40, 50 years, ideally locating something there that you're not going to ever have to sell that for a long time. And then, to the extent you have to generate taxable income, you may want to look to do that in kids' or grandkids' accounts, or if there's trusts that they're beneficiaries of, or maybe even some of their own accounts themselves that you help fund or put dollars in. Certainly there are the kiddie tax issues that you need to be aware of as well, but things being equal, if you've got other family generations in lower tax brackets, taking advantage of that location. And then another great thing to do is to take low basis securities, a stock that perhaps you paid $10 for. Maybe grandma gave you shares of Coca-Cola 40 years ago. The cost is $10. The price today is $100. If you sell that stock, you're going to have a $90 capital gain per share. If you give it to a charity, stick it in a donor-advised fund, or directly put it into a foundation, the charity then sells that. The charity does not pay that capital gains tax. In essence, that tax completely evaporates. So, continuing on that theme, location choices to avoid long-term capital gains. Appreciated assets held more than 1 year, number one, get a step up at death. Those of you that were at the Estate Planning Council's symposium heard Professor Sam Donaldson talk about how you could substitute low basis securities from a grantor trust to the grantor when death is imminent. In other words, take advantage of that step up at death. One of the other very nice features having something in a taxable account, whereas you're not getting this step up, or it's immaterial if it's in a tax deferred account, because you're paying taxes on the withdrawal. There is no basis calculation or step up from there. Donating to charity, as we talked about on our last slide, let the charity sell and realize the gain rather than you giving directly to the charity. And there was an article that we were mentioned in, Harvesting Capital Gains, that we can make available. It is on our website as well at wealthwellplanned.com. If you search for Harvest Capital Gains, you'll find that article that talks about a real neat way to be able to get that same step up in basis within your investment portfolio, irrespective if you want to sell the stocks or not. It simply allows you to give them to your favorite charity in lieu of your cash, and use that same cash you would have given to the charity to repurchase, or in essence, step up those shares in your investment portfolio. Location choices to defer long-term capital gains. You can use appreciated assets held more than 1 year to fund a charitable remainder trust or a charitable gift annuity. Now, we're using the word defer. You're not avoiding it here, but you are pushing it out to sometime in the future. When is that sometime? The sometime is when you start taking withdrawals out. So the charitable remainder trust is paying you or a beneficiary. Part of that payment will be recouping the taxes that you needed to pay in when you had the capital gains, or the same thing on your charitable gift annuity. When those payments are received by you, a portion of that will be recouping that portion that you deferred on that capital gain. So not avoiding it. If you can't avoid it, the next best thing to defer it. Other location considerations. As we talked about earlier, long time horizons favor those unrealized gains. Those would be those things such as asset protection or generation skipping trusts, dynasty trusts that may be set up for generations to come. A great place to put something in there that's going to grow, generate not a whole lot of ordinary income or dividends along the way, but a fair amount of its return and capital appreciation, that unrealized gain. As we talked about on that previous slide, charitable functions such as a charitable lead or grantor retained annuity trust, locating high expected growth assets in an attempt to have appreciation in excess of the 75/20 prevailing rate. So the idea here is you can locate things in your charitable lead trust or your grantor retained annuity trust. If you're able to generate the return above the 75/20 rate, which these days is quite low, that growth happens outside of your estate, or in this case with charitable lead, outside of your estate, that eventually will revert to your children or beneficiaries. And then finally, considering what we call a self-directed or Romney IRA. It was reported that Mitt Romney generated somewhere between $20 and $100 million in his IRA, according to a 2012 Bloomberg article. He did this combining several things. Number one, he used a simplified employee pension or SEP IRA, which allows one to put up to 25% of their income, not to exceed $52,000 for 2014, into a SEP IRA. And then Mr. Romney used what's known as a self-directed IRA, where you can purchase anything you want in a regular brokerage account, but the self-directed portion allows you to put things that normally you couldn't get access to, very highly appreciative assets such as private equity partnerships or real estate as well. So here we're going to talk about some ideas about increasing the tax-free bucket. Idea number one, fund Roth IRAs early. The idea is getting money into a Roth IRA as early as possible is really, really a great thing. Anyone under 70 and a half with earned income or a spouse with earned income can fund a Roth IRA. So when I ask people the question, what typically is the earliest age someone can fund the Roth IRA, I get a few right answers, but mostly I get them along the lines of 16, 18, 21, or never, since I don't think my son or daughter will ever be gainfully employed. But the real answer is most of you recognize on the slide here today, and for those of you that don't, for whatever reason, maybe you've been living under a rock for quite some time, this obviously is Breaking Bad, and what you're seeing there is a picture of Baby Holly. Baby Holly is a television actor, and guess what? She has earned income. So since she has earned income, she's allowed, or in this case, her parents or custodian would be smart to open up a custodial IRA, fund that with earned income on her behalf, and get those dollars into an IRA account. But let's talk a little bit further. We talked about an IRA account, but I want to talk about another thing. And remember, we're talking about how you can get more money in that tax-free bucket. So can Baby Holly fund a Roth IRA? Let's talk about a few things, and let's make the following assumptions. Number one, she's not married nor head of household for tax filing purposes. She'll make more than $121,000 in 2014, which means she cannot directly fund a Roth IRA. She makes too much money. The IRS says you have to be under $121,000 single, $192,000 married. So she can't directly fund an IRA. However, let's continue along. Let's say Baby Holly uses a cutting-edge Miami-based investment advisor who recommends she fund a traditional after-tax IRA account, which, remember, anyone can do. There's a lot of confusion out there, but it's literally you have to be under 70 and a half, and either you or your spouse have to have earned income. I can't tell you how many people that I know and I've helped open IRA accounts who said, I didn't think I can have an IRA because I have a plan at work. What the rule is and where they're getting confused is if you have a plan at work or you're subject to a plan at work, you cannot take a deduction for funding your IRA, but you can open up a traditional IRA at any point in time and even a Roth IRA directly if your income isn't too high. So many people are missing this. It's unfortunate. Hopefully a few of you watching or listening to this today will realize this and know either for you, your parents, your spouse, your kids, someone to open up an IRA. So let's get back to the slide. As a matter of course, that advisor routinely runs a Roth conversion analysis for all of his clients at least once a year. So in this case, should Baby Holly convert to a Roth IRA? She funded $5,500, the 2014 maximum contribution for anyone under age 50. If you're 50 and above, you can do an additional $1,000 per year for 2014, which means you can do $6,500. If you happen to be watching or listening to this prior to April 15th, you can fund the prior years. So in this case, right now, as I'm recording this, it's March 2014. People can still fund their 2013 IRA. I've done this for quite a few clients. I've got a client where we funded $13,000 into a Roth IRA, $6,500 2013, $6,500 2014, put it in. And this was a client who makes over $500,000 a year. So let's look at this Roth IRA analysis for Baby Holly. Funded in January, $5,500. Here we are in March, 60 days later. The funds were just in a money market account, and we're generously saying the money market earned 1%, although I don't know one on the planet that will do that, but we'll just say she was very smart and did earn that for 60 days. The interest on that was $9.04. So right now the account balance is $5,509. When we run the Roth conversion analysis, what we find out is the gain of $9.04 times her tax rate, which is the highest tax rate of 39.6%, means she'll pay $3.58 plus any state income tax to do the Roth conversion. Advisor recommends Baby Holly do a Roth conversion. In essence, she's able to get money into a Roth IRA account. TIPRA to the rescue. The Tax Increase Prevention and Reconciliation Act of 2005 repealed the income limits on Roth conversions starting in 2010. The government looked at this and the Treasury realized, and it was very effective. The research showed an additional $60 billion of Roth conversions happened in 2010. The Treasury, as we know, needs more and more money, and that worked out very well for them. So this provision is the one that allows the high wage earner like Baby Holly the ability to do the Roth conversion. Remember, because of her income of $121,000, she was unable to directly fund a Roth IRA, so she funded a regular IRA. Her advisor then, several months later, ran an analysis, said it also seemed to make sense for her to be able to do the conversion. Now, I know there's some fine print on this slide here. Just be aware of IRS code 408. Two things here in red. Number one, obviously Baby Holly didn't have an existing IRA account. So if you've never had an IRA account or you've had after-tax IRA accounts, that's fine. However, if you've ever taken a deduction for an IRA account at any point in time, you're going to run into the pro rata rule, which basically makes it far less attractive to do this strategy. So that's somewhat of a deal killer. However, there is an exception, and this exception down below says, well, if you did take the deduction, you could pick that up in your IRA. So let's say you've got $10,000 that you've taken an IRA deduction several times and it's grown to $10,000. You could pick it up and roll it in to one of your 401k plans at work, should you have a 401k plan, and should it allow for a roll-in. If it didn't by chance, you got one other opportunity. That would be to legitimately earn some self-employment income, dog walking, house sitting, doing any of those things that you can legitimately generate and pay taxes on for earned income and from a self-employment position. You could then go to a custodian. Fidelity has a 401k, a self-directed 401k account that you could open up, and you could then, in essence, roll in what I'm calling the tainted deductible IRA, not only the contributions, but all growth in that account as well. I know a little confusing. For the most part, you're safe as long as you haven't taken deductions. And remember, this is an either or. By definition, individual retirement arrangements are for the person. So the fact that you or your spouse did or didn't take a deduction doesn't taint one versus the other. So maybe you did have a deductible IRA, but your spouse doesn't. That means without a doubt, if they're a high wage earner, they can use the strategy of opening up an after-tax IRA and then rolling it into the Roth. Idea number two, the Romney IRA, but better. Those of you who have access at work to a simplified employee pension, or what's known as a SEP IRA, have the ability to fund up to $52,000 or 25% of your income, whichever is less, in 2014, into the SEP IRA. And once you get it into the SEP IRA, the IRS says that the SEP IRA account is a traditional IRA and follows the same investment, distribution, and rollover rules as a traditional IRA, which means, guess what? You can convert it to a Roth IRA. So now how this would work is you would get at first that deduction. You wouldn't be paying salary on those dollars going into that account on your behalf through your employer. The moment you can convert, though, that entire balance will be taxable. However, paying the taxes now and then being able to invest like Romney in early stage companies or private equity, real estate, or some of those other things through a self-directed IRA could be a very, very powerful combination. Idea number 3, increasing the tax-free bucket outside of your estate. This is somewhat of the holy grail. How can you do this, and why would you do that? Well, as I talked about, I've got a client in his 50s that right now is running into the issue where he's at that threshold. As we speak, it's $10.68 million for a married couple. Anything above that in your estate is subject, with current laws, to a 40% estate tax. He has 3 children, and so what we've decided to do is open up Roth IRAs for his 3 kids. And what we're doing is funding in this case, they're all under 50, so that's $5,500 per year for 2013 and 14. That's $11,000 per child, or $33,000 we're getting in. I know it's a small amount, but I want to talk just a moment about the idea of this growing over time. Remember, I talked about there's a 1 in 2 chance that either you or your spouse will live to age 92. I say this to my clients all the time in their 50s. So we're talking a 40-year time horizon. So if we continue to fund the children's IRA accounts over the next 20 years and get a 7% growth along the way, we'd likely to accumulate, or they would likely to accumulate collectively $850,000 outside of the estate. And if we do that for 30 years, that's close to $2 million. So we're talking about a lot of money that one can move systematically over time to the next generation. So the Holy Grail, outside of the estate and tax-free as well, I think just a tremendous strategy. And you can't overlook the ability as well, looking at life insurance from an investment point of view. No surprise why some of the wealthiest families have a lot of life insurance. They like it for these 2 things. Number 1, outside of the estate, if held, as long as the husband or wife aren't the owners of the policy, so the children can be the owner of the policy. It can be an insurance, irrevocable life insurance trust, some entity that owns it outside of the estate, number 1. And then number 2, that right now, tax code the way that is and likely to stay, life insurance proceeds are not, there are no taxes on any gain, irrespective of what you've paid in. So sort of the Holy Grail, tax-free, outside of the estate. If you've got any questions, you can always reach us at our office at 305-444-1610. That's 305-444-1610. We'll have these slides available on our website as well at wealthwellplanned.com. Thank you so much for listening to our presentation today.